Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe, and our guest today is Brandon Thomas, who is the Chief Investment Officer and co-founder of Envestnet, Envestnet PMC. Brandon, welcome to the show. We're so glad you would join us.
Devin, thank you so much. It's a pleasure to be here. I'm excited to talk to you about our report.
Well, you have done an interesting report, and I am excited to talk to you about this because your report answers the question of whether the returns on socially responsible investing are comparable to non-SRI investments. Now, before we jump into the report, I want to just spend a minute on definitions. Let's talk a little bit about what socially responsible investing is. What's the population of investments that you were comparing to mainstream investments?
Yes, what we did is we looked at the Morningstar database, and Morningstar, of course, is a very large firm that analyzes and researches various types of mutual funds and separate accounts and ETFs and the like. So we looked at their database, and one of the fields that they have in their database is a socially conscious field. And so any mutual fund that has that socially conscious tag associated with it, we downloaded that data and compared that data of those funds relative to funds that didn't have that socially conscious tag. So what we tried to do is really segregate the data between SRI, we call the socially conscious SRI in the report, and then non-SRI funds, which are more the conventional strategies that are unconstrained as far as SRI or ESG strategies go.
And I think to just put it out there, I think most people expect that an SRI fund would have lower returns because you have eliminated some part of the universe that you could theoretically choose to invest in and would therefore expect lower returns. What did you in fact find?
Yeah, you're exactly right, Devin. Most of the previous research before we embarked on this, the results fell into three categories, really. It was what you just described. The first category were the SRI skeptics, I guess you could call them, that said, okay, well, if you're limiting your universe of investable options, of course you're going to have lower returns because you've got this constraint on what you can invest in. The second group were the SRI proponents that would say, no, you can actually do good socially while you're doing well from an investment standpoint, and that's because the costs of SRI investing are being underestimated and the benefits, the costs are being overestimated and the benefits are being underestimated. And then the third camp was more the neutral camp that said, well, really on balance there should be no difference between an SRI fund and a non-SRI fund. And so our research was basically at the average in that last camp, saying, okay, if you've got an SRI fund, an average SRI fund and an average non-SRI fund or conventional fund, their performance really is about the same. So SRI investing at the average does not hurt you. And then as you get away from the average, there are benefits to investing in SRI funds.
Well, this is a really encouraging outcome, but I think there are some nuances in your report that we need to talk about. What happens at the when you look at the lower performing funds in and out of the SRI world?
Yes, most of the research previously had been just focused on the average, as I mentioned. And what our report tried to do, our quantitative research group set out to look at the full distribution of returns. By that I mean we wanted to look at not only the average, the mean or the median, but we wanted to go and look at the top performing funds, both for SRI and non-SRI, and then down on the other end of the spectrum of the distribution of the bottom performing funds. And we found some very interesting results. We found that the distribution of returns for SRI funds was very much more concentrated around the mean than it was for non-SRI funds. And what that means is that you have thinner, in the investment world it's called thinner tails, which means your outcomes on the bottom side, on the negative return side, will be superior to for SRI funds will be superior to those for non-SRI funds. So the upshot really is that SRI funds, the poorer performing SRI funds, perform much better than the poorer performing non-SRI funds. So it's a very encouraging outcome, because investors now can look at that and say, okay, on average, my performance is going to be very comparable to conventional strategies. But if I just so happen to pick a fund that doesn't perform well, I'm going to pick my performance is likely to be better than an SRI fund, a non-SRI fund that doesn't perform well. And so the results are very encouraging in that way.
Well, it is exciting to think about the fact that there is now that compelling argument to be looking for SRI investments over standard investments from a purely economic standpoint. The most cynical investor now has a reason to be looking at SRI, whether or not that investor has any interest in the social outcomes, right?
You're exactly right. And I was encouraged to read in the US SIF report on SRI investing trends. It was just the 2014 results were just released this week. And it's astounding how much in assets has gravitated towards SRI strategies over the last 2 years even. And the survey asked the money managers why they invest in SRI strategies. And 70% of them said that one of the reasons they invest in SRI strategies is because it improves performance and helps them manage risk. And I thought that was very interesting, because previously, 15, 20 years ago, SRI was more of an exclusionary screen, getting rid of alcohol, gaming, and tobacco stocks. Now you've got a lot more companies out there that are more positively oriented to social governance and environmental issues, incorporating those strategies in the way they manage their companies. And so now you have managers going out and doing positive screens on those types of companies, and that should improve performance. So it's the evolution in the asset management industry as far as SRI goes has really been fascinating.
Brandon, do you see in the data any evidence for the hypothesis that has long been made in SRI circles that in fact the benefits of SRI behaviors genuinely have a benefit to the investors and shareholders of those companies?
Yeah, there's emerging evidence now as the data is becoming more refined and they're capturing more of the reasons why these companies are managing the way they are and the types of strategies they're integrating. There's more and more evidence that some of these strategies do in fact actually improve the performance of the companies and hence their stock. I think one of the things that was pointed out, we presented this paper at the PRI conference, academic conference in Montreal at the end of September. And the panel of judges, one of the things they mentioned about the paper was this will likely serve as a catalyst for additional research in the area, your very area you're talking about, in terms of, we now know that there is really no difference on average between SRI and non-SRI. But as we get more granular in how we can look at these strategies, these ESG strategies that are being integrated, are there certain strategies that actually benefit performance of the stocks? And I think that's probably going to be the next area of research that we see academics and industry practitioners follow.
Well, it is exciting to think about these benefits and how they might accrue, Brandon. And I want to just ask you, are there other insights from the report that you think are important to share with the group, from your report specifically?
Yes, I think there are two insights I would just leave your viewers with. I think the first really is what happens in bear markets. I think this difference that we see in performance, superior performance of SRI versus non-SRI funds, on average is notable. But in bear markets, when the market declines, that positive difference that SRI funds provide is much superior than on average. So I think one thing that investors can take away from this is that if the market declines, there's better protection there for their SRI investment. The second highlight I would provide is one of the things that we asked when we saw the results of this study, we said, well, why is this happening? Why do we see these results? Why are the SRI funds so concentrated around the mean and provide such consistent results? And so our hypothesis was, well, the universe of stocks that they're investing in is more homogeneous characteristically, so that they have certain characteristics that allow them to perform in that way. And so I think as we see more and more companies gravitate towards these SRI or ESG strategies and follow them as they manage their companies, I think we're going to see an explosion in the number of funds and assets in this category. So I think those are a couple of the insights that I provide.
I want to just put this into a little bit of context. Why did Envestnet pursue this report? Clearly, this took some resources. Why was it an important thing for the firm to do this?
That's a great question. We have a quantitative research group headed up by Yanis Zvingelis, who is one of the principal authors on this paper. And they're doing exploratory research in a number of areas. And one of the elements of our platform, we're an investment platform that serves independent financial advisors. And one of the areas of expertise we try to provide is in the area of impact investing. And so we wanted to give advisors that are focused on impact investing some ideas on why it may be beneficial to their clients. And so the primary reason we went down this path was to say, okay, we've got a lot of assets allocated by advisors in this impact investing solutions platform that we offer, and does it make sense for advisors? So for those advisors that were already focused on that, I think the results confirm their strategy. And then what I think it'll also do is encourage other advisors who may not have thought of SRI as an appropriate strategy to say, irrespective of the social good it does, the investment performance has characteristics that would benefit my clients. So because of the nature of our platform and the number of advisors focusing on SRI, we wanted to provide them some ammunition as to why it might make sense.
Well, I think that's great. And I want to just drill down one layer further. Why is this important to you personally?
Well, honestly, Devin, I didn't have much experience with SRI prior to doing this study. My experience, I've been in the investment business for about 30 years, and I've seen it grow from the early years, sort of slowly at first. And initially, most of the SRI investing was done with exclusionary screens, where you're eliminating tobacco and gaming stocks and so forth. And slowly but surely now, in an increasing way, we've seen more of these inclusionary ESG integration screens. And so for me personally, it's sort of opened my horizons to looking at different ways of investing, and the fact that companies can follow different types of approaches and strategies that will not only benefit, that will certainly do good socially, but also have a meaningful impact from an investment standpoint. So it's really helped my understanding in that regard.
Well, terrific. Now, Brandon, tell us a little bit now, before we wrap up, on how people can get in touch with you and who is best served by getting in touch with you.
Any financial advisor, independent financial advisor, can get in touch with us by contacting us at www.envestnet.com. And so that's how you can get in touch with us. The advisors that may want to get in touch with us are those that either are not using our platform currently and are interested in using SRI screens and strategies. We have a number of screens that can be incorporated in client portfolios that are totally automated. And then those advisors that are maybe currently on our platform that really want to learn more about impact investing. I think we've got a very nice impact investing full-featured solution for them, and if they're interested in that, they should certainly contact us at Envestnet.com. Fantastic.
Well, Brandon, we want to wish you every success in the work that you're doing and congratulate you on this great report, and thank you for taking the time to share it with us today.
Well, Devin, thank you so much. It's been a pleasure, and I really appreciate your time today.
Well, thank you again. Let's do some good.